This is Rod Kusin, Spooman for Risk on Thursday, April 7th, 2011, all times on the chart, our Central Standard Time. Our video today is going to focus on some of the new aspects of our trading strategy. We've added some automated stops into the picture, and we'll talk more about what those features are in just a moment. But briefly to review, our strategy has the capacity to simultaneously monitor 12 different data streams with multiple different studies on each data stream. We can look at such things as the MACD, we can look at stochastics, average z-score, adaptive price index, linear regression, and so on down the line. One of the most promising indicators that we've seen in a long time is what we refer to as z-score. And so what we've done on this chart, we've added, just for visual purposes, the z-score indicator on a ES 100 tick chart, on a 20-day moving average of the S&P set to 30 ticks, a 50-day moving average set to 100 ticks, a 200 moving day average set to 50 ticks, VIX set to 3 ticks, and the large SPC contract also set to 3 ticks. Now we internally in the code set up certain rules that need to be met with respect to each of these indicators. So, for example, there are two components to the z-score. There's the magenta colored line here, which represents the slope of the average z-score, and then there's a momentum component as well. So one rule, for example, would be that the slope of the average z-score and the momentum has to be negative in order for a short trade to take place, or positive if a long trade needs to take place. And we could add to those rules if we wanted to by combining those conditions with similar conditions on our other indicators. In this way, we can create our own strategy based upon specific rules that, to a degree, are discretionary, but we have some default settings that we make recommendations about for those of our consumers who wish to purchase our system. Now we can run multiple strategies on the same workspace, and what we've done on this particular workspace is just that. We've elected to set up 7 different strategies on the same workspace that will give independent signals. And so let's talk about that and how the strategy was set up with regard to stops and such. So we'll open up the strategy. Here's our 7 strategies. They're all slightly different, and at the bottom of our inputs is where we can specify how we want the strategy to be set up. So we enter our account, or the simulated account in this particular case. We can decide upon a specific profit target based on the number of contracts that we're trading. And if we're trading more than one contract, we can have 2 different profit targets, and we can specify what portion of the contracts will apply to the first profit target. There's an exit at the end of the day, so if any contracts are still active, those contracts will be closed to make sure that we don't inadvertently allow a position after the close or after any particular time. We can set up our stop loss, a level at which we break even, or have an offset, as well as a profit target for the day. All of that can be pre-selected prior to the trade, and then allow the automated portion of the strategy to execute those trades within those parameters. So let's take a look at the first trades that took place. Now, as the market dropped off very rapidly after that earthquake took place in Japan today, the system simply didn't produce any trades at all. But then after the market began to hit a support level, we started to get long trades. Here we find our first long trades right in here, and both of these got stopped out. Now, they got stopped out initially with, if we look at exactly the trade here, we can look at the conditions that were set up on that particular strategy. Now, in this particular case, we had 5 ticks for the stop with a 10 and a 15 tick profit target. So the system automatically stopped us out as we reached that given level, and then another strategy kicks in and takes us long, which reaches its profit target for the initial move up. We had another set of trades that took place here that reached its initial profit target. Now, when we look closer at the trade itself, you'll notice that here we hit our initial profit target, but the market then moves against us, and we hit a break even. All right, we hit a break even here. Now we can set that up to hit break even with an offset if we elect to do so, so that we are going to at least cover, commissions on the trade. So what we mean by that, if, for example, the market moves 5 ticks to the good and then reverses, the offset here is set to 1 tick, which means if it comes back within 1 tick of our initial purchase price, we'll exit the trade with at least a 1 tick profit. It's a very simple type of stop. Now, the market actually ran up quite nicely after that initial move. And then we have a short trade that took place here, a real nice short, and in that particular case we hit both the initial profit target and the second profit target as well. The next trade took place just after 10:30. It was a long trade, and here again both of those trades hit their initial and secondary profit targets. So you can see from the way that we set this up, the system can be completely automated. Initiate the trades, put them into the trade manager, set the stop or the profit target for that matter, and then depending on when you want to quit trading, you can either allow the system to stop all trades once a specific daily profit has been reached, or just continue to trade until the end of the day. Here we have another set of trades that took place before noon. Short trades, all of those again hit their profit targets. But now what I'd like to do is draw your attention to some specific data feeds that we're working with, and we're finding real good success. You can plot this on your own. You can see how it performs by placing just about any indicator you want on it. We happen to prefer the Z-score indicator. So just to get a feel for this, what we've done is we've placed a 1-minute ES on chart 1 and a 1-minute 50-day moving average of the S&P below it. We're using a standard Z-score indicator in subgraph 2 and a slow stochastic in subgraph 3 in each chart. Now watch how this tracks. Before we discuss that, however, keep in mind that there's several ways that you can read Z-score. Z-score, which is primarily a function of standard deviation. The further away from the zero line you are, the more likely there's going to be some kind of a change in market direction. The zero line on slower tick bars, longer tick bars I should say, or slower time intervals, 1 minute, 5 minute, or better, becomes a real effective way of recognizing when there's likely going to be some change in market direction. So simply by looking at chart number 1 here, you'll notice that the zero line is crossed right in here. So from there on in, both the slope of the momentum portion as well as the Z-score average is now moving up, and it's tracking the market very, very well. But below, we find the 50-day moving average, and let's take a look at how this is running in concert with the ES. So right in here, we find that the Z-score is moving above the zero line. The momentum portion, that is moving above the zero line, and the slope of the Z-score average is positive. So here we're finding a good time to take a long trade. Now we can of course further filter this, but this is the basic concept. You'll also notice that we're divergent on the stochastic, particularly so right here where we tag the low. Come back here, test that low, we're divergent, and off we run. Now let's look at when this begins to go south. And we've dropped below the zero line here. Market really hasn't dropped much. Runs up again, and then here we have another nice short opportunity. Right in here, they're both dropping below the zero line on the Z-score momentum portion. We come down here, and on the 1-minute chart, basically we're oversold. We now move up above the zero line, slope is positive for another long trade. Now we don't get much out of that until we see the market dropping again below the zero line in both cases, and we get a nice short out of this. So it wouldn't take much, as you can see, to design some excellent strategies with the use of not only the Z-score indicator, but perhaps a stochastic. Add that to it for a more clear picture of where you're overbought or oversold. And by looking at the right data feeds to help confirm the trade, you're in a really even a better position to have confidence in the trades that the strategy will take for you. Now we've changed chart number 2 to a 200-day moving average, placed the same indicators on them, and you can see very easily where you're getting overbought, like right in here, Wait for it to drop. Down she goes. And let's move that forward a little bit. Right in here, we're below the zero line until really right in here. A nice upward slope and a good time to take a long trade. It's really easy to see this. Very easy. You can plot it yourself. You don't need a strategy. But this is one of the primary components of our strategy that we use to look at the major trends and when to enter the market. Now, just another thing about the Z-score. We said that there's primarily just two components here, and that's somewhat true. There's really three components. There is the momentum portion of the equation. There's the Z-score average. So those are two components. There's the slope of each, so that's really four components. There's the zero line, that's five components. We can independently look at any portion of what we just said, any of those five components, and set up specific rules to go along with those components. We could, for example, set up the strategy so that we never take a trade that doesn't take into consideration where the momentum is relative to the zero line. Or we could look for extremes in the standard deviation itself and set up rules this way. In other words, don't take a trade unless the Z-score average is above or below a certain level, something of the nature of a buy and sell zone on a stochastic, an overbought or oversold level. You can do that with our strategy as well. And then when we combine that with other indicators like a stochastic or other data feeds, we now begin to look at a variety of different things that help us to confirm the trade and improve the probability that it will succeed. So in our strategy, for example, we will have a switch that tells us to look at either the slope of the momentum or the slope of the Z-score average. We can just turn either one of these or both to a true condition, and then we know we're looking at that component of the indicator. Up here we have several different switches that help us to establish the rules, and we won't go into the details on that right now, but this helps us to know what specific rules we're going to apply to the Z-score and and the specific data feeds that we're going to be looking at, such as these. So it's a fairly simple way to set up the strategy, and of course there is a multitude of different combinations that a trader could use, so that as market conditions change, which they do, there may be a need to adjust certain settings to account for that. So what we recommend is that you go to our website and contact us, RSKsys.com, ask for a free demo. We'll be happy to sit down and spend time with you. We don't structure our demonstrations to a particular time limit. We'll spend as much time as you want so that you understand as fully as possible what it is that we're doing. We've only covered a few things regarding our strategy in this video. You can find out more by looking at some of the more recent videos where we have now incorporated this new indicator into our strategy. But give us a call, make comments on our videos. We'll be happy to hear from you and try to be of service to those who are serious about looking at a fully automated system. This is Rod Kusin and Spooman for Risk.